You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Aston Martin, AB-InBev, Sainsburys, Haleon, Airtel Africa, and our US company of the week is McDonald's. Sam, do you want to kick us off with Aston Martin?
Absolutely. So Aston Martin have come out with their third quarter results and revenue is up 15% to 362.1 million, reflecting an 11% increase in the average selling price to £234,000. The DB12 production ramp-up was temporarily affected by production issues impacting volumes. Full-year volumes are now expected to be around 6,700, down from previous guidance of 7,000. There's an underlying operating loss of 48.4 million, a 13% improvement on the same time last year. Net debt was broadly flat at 750 million at the end of the period compared to the start of the year. Underlying cash profits are still expected to reach around 20% for the full year, and the shares fell 16.3% following the announcement. Now, I do find the net debt very concerning at 750 million, because if you go into their past 5 years of results, they haven't actually turned an operating profit since 2018. So they had an operating profit of 72 million in 2018, although they then had lots of interest to pay anyway. So they had a loss for tax purposes. So once this is before the interest, they then had operating losses for the 4 years after that. So even if you take the best year of 70 million after the interest costs, there's still no profits for shareholders. And that debt's just getting bigger and bigger, really. So, yeah, there's not really much to do on the valuation because there's no earnings. And the business trades at a market cap of 1.69 billion, doesn't pay a dividend. And the shares are down 98% over 5 years. I don't really know what to say about this. It's just, you just wouldn't touch it. We have done it before. We agree we wouldn't touch it. If it wasn't for the fact that the product is so well known, I would probably never cover this company again. But obviously it's Aston Martin, so it does have a little bit about it. Obviously, it's good that they can increase the selling prices, but if you're losing money, they're still losing money, so it doesn't really matter, plus the production issues. I don't see any kind of future for them as a standalone company. I think one of the other automakers would have to buy them for them to be in any way commercially viable. And I'm not sure why someone would want to buy them at the minute, the figures they're putting out. But yeah, I think I only see them surviving as part of a larger group. What about you, John?
Yeah, I would agree. It's uninvestable. And I don't know, quick Google, how many times have Aston Martin gone bust in the past?
I know it's a lot. I know it's enough times that you do question who's actually buying the shares every time they're resuscitated.
Let's have a look. 7 times.
Oh, I would have guessed that. If it was a person, it would have a do not resuscitate.
Just... yeah, in 107 years, 7 times. So, yeah. Okay, fine. Let's move on then. Unless you have anything more to add.
Nothing. Absolutely nothing.
Okay, fine. So, AB-InBev, that's the brewer that owns Budweiser, Stella, and Corona. Covered it a few times on the show. They had their third quarter results out last week, with AB-InBev's third quarter revenue growing 5% on an organic basis to $15.6 billion. Excluding the accounting benefits of low-quality hyperinflationary sales in Argentina, organic growth falls to 1.6%. Revenue growth was driven entirely by high average prices as volumes declined by 3.4%. The group's largest market, North America, saw revenue and volumes decline by 12.7% and 17.1% respectively. Underlying cash profit, EBITDA, came in at $5.4 billion, which was up 4.1% on an organic basis, with margins being squeezed due to rising commodity prices. Full-year EBITDA guidance has been maintained and is expected to grow between 4% and 8%. Group's announced a $3 billion tender offer for its bonds, as well as a $1 billion share buyback program, which is expected to complete within 12 months. And the shares were up about 3% following the results. In terms of valuation, AB InBev has a market cap of around 95 billion euros and trades at 16 times forward earnings compared with a 10-year average of 20. That's a prospective yield of 2.7%. Interestingly, the net debt, as we've commented on before, is currently sitting at around 3.7 times cash profit at the half-year mark, which is some way from what the group was targeting, which was 2 times. I suppose the $3 billion tender offer should help this move in the right direction, but it, I think, did surprise the market about the share buyback, given the level of debt, which was $1 billion. I suppose you could argue that's a sign of confidence in the business, or that the owners have of the business, or the management have of the business, but a little bit bold, I would have thought. I think overall the results disappointing. It's got a lot of quality brands, but I don't think management are delivering on it. And I wouldn't say it's a business in the healthiest state. If I were looking in this sector, I own Diageo shares, and I'd be, basically straight up the Diageo shares. A bit more expensive, but I think it's a business in much better condition and with better prospects, certainly as Gen Z look like they're consuming lower volumes of alcohol and the sort of low alcohol or no alcohol alternatives. And I don't think, whilst they're strong brands, they're more sort of, I guess, volume driven in the sense of consumption with the beers as opposed to the spirits. And I guess that would lend itself more to the premiumization in the spirits. So it would be Diageo for me, but I was slightly underwhelmed with AB InBev, and I guess the last few times continue to be fairly underwhelmed by it. But still, it does have some quality brands within it, which I suspect explains why it does still retain, given the results, a fairly expensive valuation. Sam, what are your thoughts on AB InBev and these results?
I think they're quite concerning. I know they've had some image problems, but even still, it's been poor for a couple of quarters now. They're quite concerning volume declines. They will have lost market share. There's no guarantee that's going to be regained. I don't particularly like the products. I don't drink beer. I don't really see how you differentiate yourself. And I think although they are positioned as more premium beer brands, I don't view the brands as high quality as some of the ones Diageo has. I don't think the share buyback program is very good. I think you've got a management these are the ones that had the marketing issues, aren't they?
Yes.
Yeah. I think you've got a management team that firstly signed off on a marketing campaign that was not received well at all by the public. Maybe given the benefit of the doubt for that. But then they've presided over a couple of quarters of poor results. The debt's going up, and they're doing a share buyback. I understand that if they think the shares are cheap, then they should buy back, irrespective of what's going on in the business. But it is a business that has increasing debt and is losing market share, and I do question whether that cash could be better spent. And it's not that cheap either, really. I don't think, compared to historical level. I know it's dropped off. Looks like it dropped off around COVID, but in terms of when it had the image problem fairly recently, it's not really any cheaper than it was prior to then. It's not like they've been presented. It doesn't look like, based on the share price, they've been presented with this great opportunity. So yeah, I do question the decision making of the management, and combined with the marketing issue that they've had, if I were a shareholder, I would be fairly concerned. But it's not a business that I'd particularly want to be in at the best of times anyway. But yeah, I would question the management compared to, some of the other, I'd probably take a look at Heineken over Anheuser-Busch, I think, if that's because you do have a very, very similar competitor if you do want something like this. But I would agree with you. I would just buy Diageo if I was going into that industry anyway.
Yeah, no, fair enough. Okay, on to Sainsburys then.
Yes, so we've covered quite a few retailers recently, but we did cover a few weeks ago Tesco, which had excellent results. And Sainsbury's have come out with their first half results, and grocery sales were up 10.1%, which follows market share volume gains. General merchandise sales were up 1.1%, with performance partially held back by a weaker Argos performance. Overall revenue was 17 billion, up from 16.4 billion last year. The group has invested 118 million in keeping prices low and continues to pursue a value-led approach. Higher end ranges are also performing well, with Taste the Difference volumes rising over 8% in the second quarter. Underlying retail operating profit was 485 million, a 2% improvement. Retail cash flow of 520 million was lower than last year's 759 million, partly because of higher capital expenditure. Sainsburys expects underlying pre-tax profit to be at the higher end of the guidance range, at 670 to 700 million pounds. An interim dividend of 3.9p was announced in line with last year. Shares rose 3.9% following the announcement. In terms of the investment of 118 million and keeping prices low, that is through schemes like the Aldi Price Match and Nectar Prices. The balance sheet is also in better condition, with the group hitting its 4-year £950 million net debt reduction target a year ahead of schedule, along with 600 million plus of retail free cash flow last year. This does make the dividend look pretty secure. So it currently trades at a P of 12.2, and that compares to a 10-year average of 11.7, and it has a prospective yield over the next 12 months of 4.9%, and that compares to a 10-year average of 4.6. I think these are a pretty good set of results. I think in the time we've covered Sainsbury's, never seen anything to suggest the Argos acquisition was a particularly good idea. It never really seems to be driving the business forward. I'm not sure there's any obvious benefits of it, but I think in the last couple of years, I think the results have definitely improved since we started covering it. These results fairly similar to Tesco, or I think Tesco was better on the operating profit side, quite a bit better. But in terms of the revenue, they're pretty similar. So I don't think they're an awful set of results, but they're not as good as Tesco's were, which we covered a few weeks ago. I think the business overall isn't as strong as Tesco. However, I think it is stronger than it probably looked a couple of years ago with the debt coming down. I think the dividend is starting to look a lot more secure than it was when we first started covering it. So although I do prefer Tesco, I don't think it looks like an awful business. And it was a business I wasn't that keen on fairly recently. So I think management are doing a fairly decent job with this, actually. What about you?
I would tend to agree with you. It looks like turnaround is going well. It's not shares aren't expensive. It's got a decent dividend yield, which is pretty well covered. I don't know where it's not a stock that's going to deliver huge amounts of growth, but it's maybe one of those steady ones that you like Tesco's that you might have in your portfolio. Probably not one that particularly excites me. And I did sell my Tesco shares relatively recently because I thought there'd be better opportunities elsewhere. I think you can certainly do worse than Sainsbury's, though.
The only thing is as well with it, though, I think a high valuation is pretty fair because it is a better business than when we started covering it.
So you think there might be some re-rating potential there?
No, I think it's already happened. So it's only going to get so expensive. So if you do the valuation, it's pretty much in line with Tesco, which I think is a better business.
Yeah.
It's up 36% over 3 years.
Okay,
but I think a P of 11 or whereas when we first started covering it, I think the P was more like 7 or 8, and the dividend yield was probably around the same. Whereas now the P's gone up and the yield's gone down, and I think it looks pretty fair, but I just don't know why you'd buy it over Tesco.
Yeah, no, fair enough.
Right, should we move on to Haleon?
Yes, so we've been covering this since it was spun off from Glaxo. It's essentially, or was, Glaxo's consumer health division. It owns brands like Sensodyne and Panadol. They've had their third quarter trading statement out last week, with third quarter revenue growing by 5% on an organic basis to £2.8 billion. And growth was driven by a 6.6% increase in prices that more than offset a 1.6% reduction in volumes and product mix, which was largely down to the normalisation of emergency vitamin supplement, which returned to pre-pandemic levels in North America, and one-off rundowns of inventory by certain retailers. North America saw a decline of 1.5%, but this was more than offset by growth in other territories. Power brands, which include Sensodyne and Panadol, outperformed the wider portfolio with growth of 9.3%. Ignoring the effect of exchange rates, underlying operating profit increased by 8.8% to £689 million, driven by the strong pricing discipline and cost efficiencies. Full-year expectations remained unchanged, and organic revenue growth is expected to land between 7 and 8% range, and an underlying operating profit growth guidance of between 9 and 11%. In terms of valuation, Haleon has a market cap of £30 billion and trades at 17.5 times forward earnings with a yield of 2%. We have commented on it before. As part of the spin-off from Glaxo, it was left with quite a lot of debt. In terms of these results, then, I thought they were disappointing, not totally dissimilar to what we'd seen from Reckitt. I think if you were looking at the consumer goods, certainly Nestle and Unilever have been delivering better results. I appreciate they're not all sort of consumer or have as much exposure to consumer health, but I think they do have stronger brands and better margins. And at the moment, Haleon still have quite a lot of debt. They're aiming to get it down below the 3 times by the end of 2024. But with the brands that it owns and at the current valuation, I think there are a lot of better opportunities available. And there's nothing about Haleon that I think would really, drive me to buy shares. I don't see where as much growth comes from. I think there are a lot better opportunities elsewhere in the wider consumer goods sector. So it wouldn't be for me. Sam, what are your thoughts on Haleon?
I don't think the results are terrible. So if we go back to ones that we've covered recently, they're definitely better than Reckitt. So Haleon's revenue is up 5%, and that compares to 3.4% for Reckitt. Reckitt volumes are down 4.1%. Haleon's are only down 1.6%. However, they're not as good as Unilever's, which were up 5.2%, so slightly higher, and that was with just a 0.6% drop in volumes compared to 1.6%. So they're kind of between Reckitt and Unilever's, although they are much closer to Unilever's than Reckitt's. I think they've got some decent brands. I think these are some decent results. If you're looking for a consumer goods company on the FTSE, you've got a lot of options, and I'm not sure what would drive you to pick Haleon. When you look at the valuation, it's basically in line with sort of Unilever and Reckitt, and I think Unilever is clearly the better business. But it's also got the lowest dividend of the three, probably because they need the money to pay off the debt. So yeah, I'm just not sure. It's not a terrible business, but I'm not sure why you'd ever opt for it over Unilever or Nestle.
Yeah, and for reference, Unilever did try to buy Haleon for £50 billion only a couple of years ago.
Yeah, she's nowhere near now. What's it now? About 20 billion, 25?
30.
Oh, well, it's still not bad. But we've covered it in depth multiple times, so we shan't embarrass anyone any further in case we've got any Unilever CEOs or part of the executive team listening.
Okay, right then. On to our next company.
Right, our next one is a favourite of the show, Airtel Africa. Airtel Africa are basically the telecoms and internet provider in 14 African countries that we have covered multiple times. So they have come out with their Q2 and results for the first half. Total customer base grew by 9.7% to 147.7 million. As the penetration of mobile data and mobile money services continued to rise, driving a 23% increase in data customers to 59.8 million and a 23.1% increase in mobile money customers to 36.5 million. Constant currency average revenue per user growth of 9.8% was driven by increased usage across voice, data, and mobile money. Mobile money transaction value increased by 45.3% in constant currency, with Q2 2024 annualized transaction value of $116 billion in reported currency. And all these figures will be in dollars. Revenue in constant currency grew by 19.7%, with reported currency revenue only up 2.3%. In Q2 2024, reported currency revenues declined by 4.7%, which reflects a full quarter's impact of the Nigerian naira devaluation, and Q2 2024 constant currency revenues increased by 19%. While reported currency revenue growth was impacted by currency devaluation, all segments delivered double-digit constant currency revenue growth. Across the group, mobile services revenue grew by 18% in constant currency, driven by voice revenue growth of 11.5% and data revenue growth of 28.1%. Mobile money revenue growth grew by 30.9% in constant currency. EBITDA increased by 21.2% in constant currency and 3.7% in reported currency to 1.3 billion, with an EBITDA margin of 49.6%, which reflects an improvement over the prior period despite inflationary cost pressures and foreign exchange headwinds. Reported currency EBITDA declined by 3.3% as the full impact of the Naira devaluation was incorporated. The loss after tax was 13 million, driven largely by foreign exchange loss of 471 million, and this has been classified as an exceptional item, which hopefully it will be. EPS before exceptional items was 7 cents, an improvement of 3.2%. CapEx of 312 million was marginally higher compared to the prior period. CapEx guidance for the full year remains between 800 and 825 million. The remaining debt at Holdco, so that's the holding company, is 550 million, and that falls due in May 2024. However, there's cash in there of 495 million, and the group is well positioned to fully repay the Holdco debt when it's due. Leverage of 1.3x in September 2023 was broadly stable. Board declared an interim dividend of 2.38 cents per share, which is up 9%. The mobile money customer base was up 23.1% to 36.5 million customers. In the slides, they've highlighted that they've got a fast and growing young population with 2.8% population growth with a median age of 17.9 years. They've also had 23 consecutive quarters of double-digit revenue and EBITDA growth when measured in constant currency. Their SIM penetration in the markets they operate in is only 48%. That compares to 55% for Africa as a whole, and then the next lowest continent is Asia Pacific at 74%, and that compares to North America with 88% unique SIM penetration. So there's a lot of opportunity, even if it just caught up Asia Pacific. And 4G adoption remains at an early stage, with only 21% 4G penetration of the total customer base, and data penetration of the total customer base of 40.5%. And in terms of the mobile money division, that's, as we covered before, a very significant opportunity. So in Airtel Africa's regions, only 32% of adults have a financial institution account. That compares to 95% in North America and 40% in sub-Saharan Africa, and about 50% or just over 50% in Middle East and North Africa. So again, significant opportunity. And the Airtel Money customer base has been compounding at a 23.1% 5-year compound annual growth rate, which that's very good as well. In terms of the valuation, obviously the foreign exchange loss has just massively skewed the PE. But if we go off last year's earnings, which I think it's fair to treat as normal, it would trade at a normalized PE of 8.11 with a dividend yield of 3.75%. My view is I'm very happy with these results. We were already aware of the foreign exchange loss because we were told about it in the last quarter. I think it's actually pretty good that apart from a quarter or two of worse results, it's not really made any difference to the business. All it's really done is maybe set them back a year's worth of growth, because that's, if you go back to last year's figures, that's basically where they were before the currency write-off, which does show the strength of the business. They've not really had to take on any extra debt to deal with it. There's not really been any apart from the loss, which isn't great, but they can't do anything about it. There's not really been any sort of follow-on effects from it. They have just sort of shrugged it off, which I'm pretty happy with. Very happy with the direction of the business. What are your thoughts, John, as a fellow shareholder?
I thought they were pretty good results. I know there are difficulties in Nigeria, but I think long-term growth trends, Airtel's right on the back of those, particularly with data, mobile money, and as you say, the penetration with 4G has a long way to catch up with the West. So I think it's in a great position, really.
What do you think of the foreign currency loss and the impact that's had?
I think, as you say, we were warned about it, and it is a risk in the sort of regions that it operates in. But I think going forward and in the longer term, I wouldn't be overly concerned about it. And I think it is reflected in the price too.
I mean, in theory, you obviously wouldn't want it to, but I think something like that could happen probably like every 3 or 4 years, and you could still do very well on the stock.
Yeah.
Now, you'd hope it doesn't happen again, and it was a one-off measure. But as long as, I mean, if it's every year, it's not good because it's basically just killing. I mean, it's killed a year's growth, really, because they've had to grow 20% just to get back to where they were. But as long as it's not doing it every year, it doesn't really make a huge difference.
Yeah, no, exactly.
Right, should we move on to a slightly bigger business?
Yes, so biggest of the week, and I suppose one of the biggest businesses in the world, McDonald's. They had their third quarter results out last week with total revenue in the third quarter of $6.7 billion, marginally ahead of forecasts, with like-for-like sales up 8.8%, and strong growth was seen in both the US and overseas. Operating profits were up 16% to $3.3 billion, reflecting strong overall revenue growth and good cost control. Full-year operating margins are expected to be about 46%, up from previous guidance of 45%, and the free cash flow conversion target is 90%, and that remains intact. Quarterly dividend was increased by 10% to $1.67 per share, and the shares were up about 2.5% in early trading. In terms of valuation, McDonald's has a market cap of $195 billion and trades at 21 times forward earnings, compared with a 10-year average of 22.4, and has a prospective dividend yield of 2.8%. I thought these results were really good. I think in some ways they could have been better had prices been hiked a bit more. But actually, I think given that McDonald's is more of a value proposition, keeping them low, retaining the customers, and potentially increasing the volumes as some people may trade down or may use McDonald's more, is the sensible approach. It's got a very strong brand, and I think perhaps these results are considerably better, or better than we've come to expect in recent years. They haven't been, I think, as good as the market had been hoping, but yeah, decent. So I actually thought it was a good set and not outrageously expensive for the quality of the business. What were your thoughts, Sam?
I know it is cheaper than other American businesses we've covered in the last couple of weeks, like Coke and Pepsi, and its results are as good, if not better, than those businesses. It's definitely cheaper, but it's still 21 times earnings. And I just don't really see where the growth is. I only really see it growing with inflation. Maybe it can increase market share a tiny bit, but it's probably one of the most saturated businesses in the world. It is a fantastic business, but I think to buy the stock and actually do well on it, I think you probably need it even lower than 21 times earnings. Although the dividend yield isn't terrible at 2.5%, not for an American stock anyway. They do tend to be a bit lower. But I think you'd probably, I don't know, for me, if I was looking at McDonald's as a business, although I know it is very, very secure and very safe, and there is probably a premium you pay for such a quality business, even still, I probably wouldn't want to go any higher than low teens.
Is there another business in the sector that you prefer?
I don't think we've really covered enough. There's definitely brands that I prefer, but we've actually, no, we've covered Wendy's. We've covered some of the more growthy ones, haven't we? I don't think I'd want Yum Brands, which it's not publicly owned anyway, but I definitely wouldn't want Burger King. I don't think we were blown away by Wendy's. I think it did seem quite expensive. No, I think if I were to go into the sector, I would probably want McDonald's, unless there was some really small chain that you managed to catch early on. Say you found it anecdotally and it ended up sort of taking up, if you'd got like Taco Bell in the early days or something like that.
Yeah.
But that's probably not going to happen. And for every one that succeeds, there's probably thousands that fail. But I just think with McDonald's, you're not really getting growth because of how saturated it is. So if you're buying it for income, I think you need more income than 2.5%. As secure as your capital probably is. I know it is, because you can get better than that. If it's not going to grow and you can only get 2.5%, you may as well leave it in the bank.
Well, I suppose that is something that has knocked the markets with rising interest rates, or one of the many things. But
it's better value than Pepsi and Coke. But it's still quite pricey, I think, for what it is. What do you think of the valuation? I know you said it wasn't bad, but
Yeah, I suppose it's when you come to some of these these high quality American businesses, they aren't cheap, but like you say, it is very saturated, and I think there are other businesses, even if they have slightly higher valuations, quality American businesses that I would probably rather own. Well, I would definitely rather own than McDonald's, which still I would see are less, being less saturated and have more growth ahead of them. But I think they're still, good results from a good quality company.
But I think some of the other businesses, I don't know, for example, like in America, one of the big US businesses that I would love Nike at the right price.
Yeah.
But with Nike, although it's pretty saturated, there are still other markets it can go into, and it's got the direct consumer. I know McDonald's has the app, but I do genuinely see the McDonald's app as really, all it's doing is it's just shifting some of the sales. I think mostly sales that were already there. It's making it easier for people to order, so maybe people are ordering a bit more. But if you compare that to direct consumer for Nike or Adidas, where all this margin that they weren't previously getting, they now can get because they're doing it all themselves, it does give the business somewhere to actually go in the medium term.
Yeah, no, absolutely.
Anyway,
okay, of the companies this week, then, which is your first choice and which would come last?
So my first choice, fairly easy. It's Airtel Africa. I genuinely thought it had the best results. I know I'm biased because I own it. If I was to exclude it on the basis I owned it, it would probably be Sainsburys, quite an easy second choice. And then in terms of least favourite, it would just be Aston Martin. It's not even difficult. What about you?
Yeah, I mean, Airtel is the only one I own, and I still really like it. Least favourite, it's got to be Aston Martin.
Right. I think that's everything then.
Thank you very much for listening, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.